I love all this development talk as well. I mean, the base, if you are capable and you know your market well enough, the basis you're going to get typically by, getting your own land, entitling it, horizontally developing it, going vertical. If you can take all that risk yourself, your all-in basis is, and this Mustafa kind of mentioned it, but glossed over it there. He's able to then re-syndicate his deals because his all-in basis is so far below. Like he may be all in. I mean, I'm going to use deep South numbers, but he may be all in for 180,000 a door, but it appraises for 250, right, or 300. Those numbers are probably not quite there for New York, but the delta is the same.
So now the question ultimately investors should be asking me is whatever is like most pressing to them, because sometimes investors don't feel comfortable asking that question, or they feel like they're asking too many questions. There's no such thing as too many questions. Ask as much as you need to build a relationship you want. And that's how I would approach it, because ultimately I might not have all the answers you're looking for, but I'm definitely going to try to be responsive, try to understand what's the heart of your question, and give you the resources to say, hey, listen, I understand that you feel unsafe, that it's not the right time to invest. I don't want to tell you it's the right time to invest. Here's a resource talking about when is the right time to invest. And that's kind of how I approach it.
You're listening to the Real Estate Runway Podcast, powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway Podcast. Happy New Year again. I think this is my 4th episode today, so I've probably said that, and you'll be hearing Happy New Year for the next month, but that's okay. I love you all anyway. I have with me the one, the only Mustafa Ladha of Veloce Capital. I'm so glad we could finally do this. Mustafa, did we reschedule this like 5 times, I think?
I think so. I don't know if I can count that high, Chad.
We had a couple, and I know once you had a break-in or something of that sort. So gosh, I'm sure there's a story there, but we're glad everything's okay and we could finally get you on the show here. And folks, before we get started, if you get any value out of this or anything else we produce, interact with it, like it, subscribe, share it with someone who needs to hear it. Just pay it forward and make sure somebody else gets to hear the episode, because anytime you push a button, that tells the algorithms you liked it and it will show it to more people. Okay, that's how it works. So Mustafa, welcome to the show, brother. How are you doing on this fine Friday morning of January?
Thank you, Chad. I'm doing well. I think it finally feels a little like winter this week. I don't know where you're based, but I'm in New Jersey and it's gotten a little chilly.
Yeah, likewise. I'm in Nashville and it was 26 degrees this morning. For us, that's very cold. So
That's good. That's good.
Yes. And so let's take a walk down your storyline a little bit. So tell me the relevant points. Tell me where you came from, what you did, how you got into the field that you're in today, and what you're doing today before we get into the meat of the episode.
Sure. More than happy, Chad. So I started off, I went to Rutgers University. I studied genetics. I went to med school. I decided it wasn't for me. And then I was kind of in this phase where I was trying to figure out, what I'm going to do next, so to speak. I went and I worked in the pharmaceutical industry. And along the way, I had a couple different, side hustle, quote unquote, businesses that I started. And then ultimately, after a couple of them, couple successes, couple, scaling, but not scaling enough type situations, then I went to, my family business and I looked at it and said, okay, like how can I add value? And my family business, was fundamentally managing our own family capital. We'd done a lot of different real estate stuff in hotels, in, multifamily, single family. And at the time we were doing a lot of, syndicating type, investing our own capital in a co-GP structure and also a little bit of syndicating. So that's really, what's led me to where I am now, where over the last, 6 or so years, I've been raising capital, structuring deals, figuring out strategic ways to not only deploy capital, but access capital through, retirement funds, self-directed IRAs, whole life insurance policies, a lot of different, strategies out there to ultimately invest in real estate and scale your portfolio. So that's really what I've been doing for the last, half a decade plus.
Yeah, that's fantastic. And so it sounds like your family has been in real estate and money management for quite some time. You were already exposed to the syndication world of using private equity to create, investment opportunities, and therefore receiving a disproportionate share of the proceeds for operating the deal. So what kind of led you to, down the capital route? It sounds like you're kind of a structurer of capital or creator of investment opportunities in the private equity world. What led you that direction?
A good question, Chad. I think it's probably kind of similar to you guys with Quattro, in the sense that you kind of look at each individual and you say, okay, what am I best suited for, and where can I scale the most? And I think that's what it is for us as well. Like individually, I've done my own deals where it's like a solo type operation,
Yeah.
and those haven't necessarily been the most lucrative. Like you learn a lot and you grow a lot, and all of that is great. But sometimes as you scale, you kind of figure out, hey, I'm really good at this, and somebody else is really good at that. And together it just makes more sense,
Yeah.
To scale a business around that. So that's kind of what's happened for us in how we invest, right? Like our partner that we've worked with for over a decade, we've done over $1 billion in transactions with him. He's a third generation operator, right? So that's what he's very good at. For us, as a family, we manage our own capital, we've scaled our own capital, and we've invested in a lot of industries over the years. And so coming into that with that mindset, like as an individual, I came from more of a science background. It's a little bit more analytical, a little bit more like underwriting type mindset. And then you kind of see what you're good at over time and how you scale. And that's really led me to not only structuring deals, but raising capital, where at this point, independently, I manage over an 8-figure portfolio. And as a company, Veloce Capital is a 9-figure portfolio. So it's a decent size, and real estate, there's always more opportunity to scale. So that's kind of where we find ourselves.
Yeah, that's absolutely right. I love hearing the evolution of the story there. And so, let's kind of talk a little bit about Veloce Capital and what sorts of projects you're investing in, what sorts of investment structures you're putting together. Like, what are y'all doing?
Good question. Good question. So we invest a lot in the Northeast, primarily in the New York City metro area. We do some investments in Maryland and in Atlanta, Georgia, but primarily a lot of our bread and butter is in the New York City metro area. And in that market, there's opportunity zones, which are basically different geographic regions that are incentivized for developers to go in and actually do development. And in
Yeah.
return for that, you get tax abatements, lower property taxes at a very fundamental asset level. So what that means for the investor or for us is that the net operating income, like your cash flow is higher, and then ultimately your assets are worth more. They appraise for more. So that's what we do a lot of. We'll go in, we'll buy assets, we'll rezone, we'll develop, and then ultimately refinance our capital out. And then with that, we've noticed that for investors, there's a lot of different strategies they want. Sometimes they want like a debt fund that has like a fixed return. Sometimes they want an equity fund where they make more when we make more, right? And then other times they want like a syndication where it's a more 10-year hold type strategy where you get negative K1s and you get tax deferred income. So really over our life cycle, we've noticed that investors, there's no one size fits all strategy. So you want to be as nimble as possible to really understand the needs of the person you're talking to and build out a strategy around them, if that makes sense, Chad.
Yeah, that makes perfect sense, and we're going to come back to that, before we get too far down the road here. The one that catches my ear a little bit, I live in the Southeast, right? So investing in New York is it's like the opposite of my strategy, right? Because we have local laws, landlord friendliness, and all that. But you know what?
Yeah.
It's a thriving city, and somehow there are still real estate tycoons who make a killing in New York City. So tell me about investing in New York City, because my friend, that is a niche, and being local to the market is key. But tell me about that. Tell me about the opportunities you're seeing right now, how the market looks, what your headwinds and tailwinds are. Like, let's talk about why one would join you in New York City.
Sure, Chad. So I think fundamentally with any investment, at least in real estate, it really comes down to the operator, in my opinion, right? Like every market has some opportunity to make a lot of money, and it's just about understanding who's making a lot of money in this market. And when I see like the Sun Belt, I think of like my Twitter feed or something, and I just think that it's on trend, and that's not inherently a bad thing. But then when I look at like the metrics behind it for what we do a lot of ground up construction. Now, recently I was on a site tour, let's say 6 months ago. And every time I would go on the site tour with some of my clients, I'd point to this building and I'd tell, hey, go on Google Maps and you'll see a parking lot, because that's what it was. And Google Maps hasn't updated yet. So for me, it's great, quote unquote, marketing that Google is doing. And then they would ask every so often, when's the CL coming in? When is it getting stabilized? All of those questions that are very relevant because I'm in ground up construction. So I was going through, these site tours over, a few month period. And then I'm like, okay, hey, we got CO as of, it was in January. I said, we're getting CO next month. And within a month, 22 of the 24 units were rented out. That doesn't happen in the South, at least not in the areas that I'm familiar with.
It does not. I've leased up buildings.
And it's like, June 1st, we get CO, 22 of the 24 units are rented out June 1st. The next one is like June 15th. And the last one is like October 4th or October someday, right? So when I look at that, I think that's one of the reasons why you'd invest in the New York metro area. Number one is just there's so much demand. New Jersey alone is the most densely populated state. New York, major metropolitan area. So when you have that, and then you have, ground up construction where you're adding a lot of value, you have tax abatements where for 20 years, on some assets, 30 years, you're not paying taxes based on the value of the asset, you're paying taxes based on the value of the land. So you have a $24 million asset and you're paying taxes as though the asset is worth like 200K. It's a huge difference. It's a huge savings for investors. So fundamentally, as real estate investors, a lot of us tell ourselves that it's all about time in the market. And that's why you choose a stronger market, very simply, because that market, you're making a lot of money now, and the market will appreciate a lot over the next 10, 20 years. So you're in a very safe spot, if that makes sense, Chad.
Yeah, it does make sense. And I think you can't discount the local knowledge in a city like that. To your point, right? If you're out of state trying to invest in a fast moving city like New York City, and you may see, for example, oh, my diligence says that this is still a parking lot. I should go chase that piece of land. And then you load to your someone's already, literally 2 years ahead of you, right? And have built a building. So I love that. And so let's take it over to, the investor side a little bit. You focused on, or you discussed that, there's not a one size fits all solution for investors. And so how do you, how do you source your investors? What avatar are you looking for? Who is right for you? Let's go through that. Who's right for Veloce Capital?
It's hard to say, because when you say who's right for Veloce Capital, it's like the ultra high net worth individual. Because fundamentally, as a company, we grew managing our capital and like friends of friends type thing. And so that's kind of the realm of like Veloce Capital historically. And then you have like my perspective, which is let's make everyone money, which is very hard to build a avatar around, right? So because of my background, corporate America, just because of the people I've interacted with, I feel like you have two sides of the coin, where you have people who want to make money and don't know how, and you have people who have money and don't know how to scale their money because they're spending all their time working, right? So those are the people sometimes that, we don't catch them necessarily. We're not necessarily having the conversations with them. So for me, it was about building out a platform and a strategy where anybody can invest, where you can, deliver proof of concept, you can deliver a strong return, and people don't have to wait 10 years or 5 years or 7 years, which is the normal syndication timeline, right? So we built out a Reg A Tier 2 fund where people can invest as little as 5K with a 2-year minimum investment period. And, they get regular statements from a fund admin, so they kind of know how the performance is. And the goal there is really to minimize that life cycle that an investor has to invest or feel married to a property, because real estate can be a long game. A lot of what we do is we go in and we add a lot of value, and then we look to exit. We don't necessarily look to hold all of our assets, especially in the fund model. In the syndication model, then yeah, definitely we're holding for as long as possible, because we're recouping our investment in the first 3 years in that model, right? So it just depends on the model. And ultimately, to your point, it depends on the avatar, right? So for me, traditionally, a lot of my clients are referrals. That's really how I've grown my base of investors. A lot of it on WhatsApp. I've raised over 8 figures on WhatsApp. So it's kind of that model. and then, transitioning to LinkedIn and all these other different social media platforms to just say, hey, this is what we offer. If you're interested in looking to learn more, book some time. We'll chat. We'll understand if I'm a good fit for you, if you're a good fit for me, and then accordingly we'll talk strategy. That's kind of how I approach it, Chad.
Yeah, that's incredible. And so let's talk about, it's 2024, right? We're in January as of this recording. I don't know if you'll be hearing this in February, but we're in January. So what is on the runway for Veloce Capital in 2024? What are you guys working on? What's your aspirations? Like, where are you going?
Good question. Good question. So I think for us, we have a lot of projects that we syndicated, maybe 2 years ago that are on track to complete today. Not today, this year, excuse me. So we have 138 units that we're building in New Jersey that should pay out investors, in the next couple months, which is very exciting. And that was, one of our syndications, ground up construction, quote unquote, long hold for our timeline. It was about a 30-month investment period for investors, right? So we bought the land, we rezoned it, we got it shovel ready, and then we syndicated. So that was that project. So that's one example. That was, built through COVID, built through this environment of high interest rates, which might change in 2024, built through all the uncertainty that goes on in life. So it'll be nice to see if it hits, the high double-digit return that we're projecting. And then we have a couple, assets that are already built, already stabilized. So your quote-unquote value-add type strategy, except these are assets that were built between 2018 and 2023. So they're new construction. There's no major CapEx. We built them, so there's an appraised price, appraised value, and there's our cost to build value, right? So there's a huge delta there. So we're able to syndicate that out to investors and say, hey, if you want a core asset, 30 to 45 minutes outside the city, you want to buy at an amazing, purchase price, and you want to hold this long term, that's the play for you. And there, it's the only issue is, like liquidity, right? The strategy is that you get a preferred return until refinance, which is projected in year 3. But ultimately, after that, the intention for those types of investors is to hold, right? If they actually want to exit their equity, that's when you have to look at secondary markets and things. So that's a different type of investor. For most investors, if they're accredited, typically they start out in like the debt fund, which is a fixed return. They can be paid out monthly, they can be paid out quarterly, semi-annual, or annual. It's a very liquid vehicle. And then there's also the equity fund, which has historically outperformed the debt fund. It just depends on the person, if that makes sense.
Yeah, it really does. I love all this development talk as well. I mean, the base, if you are capable and you know your market well enough, the basis you're going to get typically by, getting your own land, entitling it, horizontally developing it, going vertical. If you can take all that risk yourself, your all-in basis is, and this Mustafa kind of mentioned it, but glossed over it there. He's able to then re-syndicate his deals because his all-in basis is so far below. Like he may be all in. I mean, I'm going to use deep South numbers, but he may be all in for 180,000 a door, but it appraises for 250, right, or 300. Those numbers are probably not quite there for New York, but the delta is the same. So let's talk a little bit about you're primarily doing ground up development, right? And you have various investment vehicles in that realm. What is the typical, let's talk risk for a second. So for an investor considering, hey, I want to be a investor in this debt fund or equity fund or something of that sort. What does your capital stack look like, via debt and equity, or are you using debt at certain phases of the project? Like what can go wrong that an investor might need to look at, and maybe share some stories there.
Yeah, good question. I think, every investment carries risk, and it's important to really discuss that and understand and try to quantify risk or qualify it. However you approach risk, it's important to do a deep dive and say, hey, let me understand, what can go wrong. And that's why I like to start with that debt fund example, right? Because there, basically what we're doing is we're lending money to the developer, right? So that's how we're able to pay out monthly, right? So now at that level, what we're doing is the fund itself owns the asset. The individual is just getting a 1099. So they're getting interest income, and that's how it's structured. So the fund is protected. The investor is loosely protected. That's how I would word it, right? Just to kind of accurately convey the risk associated. What's the risk? The developer would have to default on $1 billion portfolio, and then we would have to default to ultimately impact the investor, right? But for some investors, it's not the right play because they don't own the equity directly, right? So it's not an asset-backed investment for them. It's an asset-backed investment for the fund. So then you go to, okay, there's another model. In the other model, you're an LP, so you're a limited partner in the fund, you're an owner of the fund, and the fund owns the real estate. Now, you mentioned those deep south numbers, right? If you're getting in at 180 a door, and at the end of a year, 2 years, whatever the time frame is, it's worth 350, there's inherently a lot of value in that. But what happens in year one if construction is not going well, or if there's some issue? You're not necessarily going to be able to sell at 350. You might be able to sell at 180. It might be 160. It just depends on the market. Now, I don't know those other markets, but in New Jersey, it's a very strong market. So typically what happens is as soon as we rezone land, it's worth much more, right? So it depends on the life cycle when you're entering the investment. Are you entering, pre-rezoning, which we have that option? Are you entering once land is rezoned and we're going vertical? Are you entering once we've built, right? And in each stage, we're looking to create an environment where the investor is walking into positive net worth on paper, right? Because what ends up happening is if you're buying an asset below appraised value, in theory, you've made money on paper. And then it's, okay, can we realize that profit? What does that look like? How do we mitigate risk for the investor? Because when we look at it, we're investors first. That's how we approach these things. That's how we underwrite. Now, ultimately, in that other strategy, that last strategy where you're syndicating and it's already built, it's already cash flowing, that's the lowest risk in my opinion, because you can look at it and you can say, hey, it's already cash flowing. So now I'm buying into an operating business. Yeah, I'm buying a real estate asset, but really what I'm doing is I'm buying a passive business for myself where I'm a partner with Veloce Capital. Veloce Capital is going to make sure they get paid. They're going to make sure I get paid because that's how they make money, right? And then ultimately we're in it together because for us, we're looking at it like a long-term relationship. It's not just about the deal today. It's about the tens of deals that we can do over the next, decade plus.
Yeah, that makes a lot of sense. So, wow. I mean, we've covered a lot of ground here. It's incredible what you guys are doing up in the Northeast. I don't come across a lot of players from New York City, so it's fun to, or Jersey or anywhere like that. So it's fun to hear what you guys are doing, how you guys are exploiting the opportunity zone, tax benefits and things of that sort for your investors. So, let's kind of start landing the plane a little bit. Give me some final thoughts. Like, what should an investor be asking Veloce Capital, to whether it be risk abatement or things about your company? Like, what have we not covered that they should be asking?
No, I think it's a great question. I think, for an investor, fundamentally, they should ask questions that are deeply personal to them, right? So sometimes you'll have a conversation, Chad, or I'll have a conversation with somebody and they'll mention they lost money in real estate. And I don't know about you, but when I hear that, at first I'm like thinking like, or like, okay, like something went wrong. That doesn't reflect me, right? So when I talk to investors, I think it's important for them to also reach out to people who have worked with us, whether they're currently working with us for 1 year, 5 years, whether they're not working with us right now, just to understand their experience. While understanding past performance doesn't indicate future performance, but it can give you an insight into, working with Mustafa or working with Veloce Capital. Because ultimately, like you, me, the person listening to this video, we all work hard for our capital, and our capital is a tool to accomplish something, right? So when we're looking to invest, we want somebody to treat our capital ideally more important than their own capital, right? And we want them to safeguard it to the best of their ability. But like we mentioned, all investments carry risk. And whenever I'm on a conversation, whenever, I'm having a conversation with an investor and I feel like they're more concerned about the risks, or they're like, it's going to be their first private placement investment, I'm very apprehensive for them. Because obviously I want them to have a good experience. We have a good track record, all of that good stuff. But fundamentally, they're entering uncharted territory, and I don't know them well enough to understand how they're going to navigate, the stress or the pressure, and they're passive investors. So there's less of that, right? But the uncertainty of, hey, I'm going to hear back from Mustafa in a month with my ACH, and you're not even going to hear back from me. It's just going to be money in your account, right? So that can be stressful for people. Or, hey, I'm wiring Mustafa money. Did he get it? Or, hey, I'm going to invest in a 3-year project. I'll get updates, but I'm not going to see that money for the next 3 years. And now COVID hits. And now everyone is telling me lumber is more expensive and concrete is more expensive. And there's all of these different things. How does that impact my investment? And I'll be like, yeah, it's more expensive, but rent has gone up so much. So it's like you kind of need to know, what's going on to then understand how that impacts me, the investor, because I'm an investor alongside you. So now the question ultimately investors should be asking me is whatever is like most pressing to them, because sometimes investors don't feel comfortable asking that question, or they feel like they're asking too many questions. There's no such thing as too many questions. Ask as much as you need to build the relationship you want. And that's how I would approach it, because ultimately I might not have all the answers you're looking for, but I'm definitely going to try to be responsive, try to understand what's the heart of your question, and give you the resources to say, hey, listen, I understand that you feel unsafe, that it's not the right time to invest. I don't want to tell you it's the right time to invest. Here's a resource talking about when is the right time to invest. And that's kind of how I approach it, because inherently, when I'm investing, if somebody's like too salesy, I don't like it. So my sales approach is very unsalesy, where I don't, push people to invest or anything like that. It's more, hey, this is what I can do. If you want to sit on the sidelines, no problem. Just let me know how often you'd like to be updated. And ultimately, we'll continue to do deals and I'll keep you updated. And that's how I approach it, Chad, if that makes sense.
It does. And let me stack on that a little bit, Mustafa. Folks, if anyone is trying to sell you or put urgency on you or anything like that, they probably need you more than you need them. Okay. And so the last thing that Mustafa or I or any other reputable capital raiser wants is investors with remorse. We do not want you to have buyer's remorse on your investment, because what's going to happen is you're going to be a pain in our rear ends as you're calling us every other week wondering what's going on when you're getting your money back. We don't want that. We don't want you to be unhappy. We want you to be comfortable, certain that this is the investment that you want to make. It's the right time for you. And so if you feel pressured or sales driven or anything of that sort, you should back away. And I think by listening to Mustafa, you realize you shouldn't feel that with him. You shouldn't feel that with us or anyone who's reputable, because if they need you more than you need them, it's not a good fit.
And I think that's the thing, Chad, just to add to it, like, good deals don't last forever, right? Everyone wants a good deal. But like when I say, hey, the deal will be gone in like 3 months, that means you got early access to the deal and it will most likely be done in 3 months. Like, I have soft commitments. People fall off and aren't able to fund for, lifestyle reasons and emergencies. But in general, like, if there is a deadline, it's usually well in advance. Or if you're finding out about the deal today and the deadline is next week, I'll tell you this is not the right deal for you, because we haven't had time to have the conversation. If you want all the information, I'll give it to you. But the deadline on this deal is next week, and I wouldn't recommend investing. And that's how I approach the conversation. That way, people feel urgency and they feel FOMO and all of these things that I don't like, because I feel like it's like pressure tactics. But fundamentally, it's important to also communicate clearly that, hey, everything in life has an expiration date and a timeline. Good deals don't last forever, but we have deal flow. So we'll figure out another deal. You might make more money, you might make less money, but ultimately you'll have the time to understand the risks associated, which is something that Chad and I were discussing. And then you'll make an informed decision. That way, when you make money, or God forbid, when we lose money together, at least we understand, eyes wide open, the risks associated with investment.
That's it. Well, we'll let that be the mic drop moment for the episode, Mustafa. Let's go to a couple of questions, get to know you a little bit better, and then we'll let you back to your very busy Friday. Sound good?
Sure.
All right. What is your superpower? Could be life or business, and how does it serve you?
No, good question. I think fundamentally it's just connecting capital with high return on investment opportunities. Like we mentioned, everyone is looking to make money, and you and I both know every capital raiser and operator is looking for money. So that right there is like a perfect marriage, so to speak. But we both have to qualify each other, right? So it's about connecting the two And it's harder than you realize. And it's harder than I realize. It's harder than everyone, even the person listening to this, realizes, because our goals are different fundamentally. And we need to understand that sometimes, the timeline doesn't work out. I need money back in a year. Your investment pays back in 5 years. Whatever the situation is. And it's important to kind of communicate that. That way, me as an investor can understand and scale with the person who's an operator. And concurrently, the operator can scale with those people that are investors. And then everyone kind of understands the types of deals that we're looking to get done.
Yeah, that's incredible. Let's flip the coin over. What is your biggest failure, life or business? And more importantly, what'd you learn from it?
Great question. So I probably glossed over it in that first question where you're telling me that life story. But I think the biggest failure probably would be going to med school and just learning through that journey, right? Because it was a great opportunity that taught me what opportunity cost really means. It's one of those terms that, like, if you have any econ or business background, you learn the phrase opportunity cost. I have a genetics background, a lot of business experience, no formal business education, right? So for me, opportunity cost was going to med school, which was, the purpose was to help people. I want to become a doctor to help people. But all through my life, I come from a business background family, right? A lot of entrepreneurs. So I always saw people helping each other through business. So when I went to med school and I was studying to become a doctor, it really dawned on me, like, the cost of becoming a doctor, spending 4 years in medical school versus figuring out how I'm going to help people today. And that ultimately was one of the many reasons why I quit med school. Then I wanted to figure out for myself, like, how am I going to scale? How am I going to help people? And what is that going to look like? Right? Because you can help people. This podcast is helping people. Us smiling to each other is helping you and I have a great conversation, right?
Yeah.
So there's many ways to help people. And that journey of getting a traditional job, realizing that the quote unquote American dream, I don't really know if it works necessarily. Working 9 to 5, retiring at 65, living, let's say, another 10 years, and then not being around anymore. Those numbers don't make sense to me, right? So it presented a huge problem / opportunity to say, hey, how am I going to scale my own personal finances to be in a position to employ people, to help people learn about their money, which is something that I don't think is talked about enough. It's not like there's a course in high school, Managing Your Money 101, or in college. I don't think that course, at least when I went.
In fact, there's not, or we'd have a fiscally smarter population.
Exactly my point. And that's why podcasts like this are thriving, is because fundamentally, we as a society, prioritize things that bring us value. That's why people listen to this podcast, right? The education system has not prioritized necessarily financial literacy. And so many of us are in a position where we're looking for that, and we have to kind of prioritize it ourselves. And that led me on my journey to basically question, like, the way the system is set up. How can I scale? How can I help other people scale? Because growing up, I always viewed money as like a tool, right? It's like the world is your oyster. You can accomplish whatever you want. Money is not an obstacle, right? So if that's like the mindset day one, then it helps you get ahead a little bit, because most people's mindset is money is finite, right? So going from that mindset to, hey, you've graduated, you're in a W-2 job making like, 40K or whatever it was, 50K, whatever that is. In New Jersey, New York, it's not really enough to survive. Even if you're at like 150, it's not really enough to survive, in my opinion, right? So it's like, hey, how do you scale? And that's kind of led me on my journey of like more self-discovery than anything, because fundamentally, if you go to 10 people, say, hey, let's figure out how to make money, more than one of those 10 people is going to have good strategies to say, hey, this is what we could do. Then it comes down to dedication, drive, all those other factors. But whether it's real estate or something else, there's so many ways to make money. It's just on us to figure that out.
Wow. That's perfect. I loved hearing that. So last question of the day, folks. As you know, Quattro prides itself on following 4 main pillars in our business. That is people, Property, Profits, and Philanthropy. It's a group of people coming together around property to generate profits, some of which are used for philanthropy. Guess what? Coming back and taking care of people. See what I did there? Full circle. So I love to give our guests an opportunity to just talk about your philanthropic heart. What do you do to do good while you do well? Could be time, talents, treasures. Just want to know how you give back, man, and maybe how the audience can support as well.
Yeah, sure. So I'm typically pretty private about this. I know we spoke about it before the recording as well, but I think it's really important because at least in our real estate circles, I don't see that much of this type of conversation. So as a family, we run a food bank in Tanzania. My dad was born in Tanzania. That's in Africa. My grandfather as well. So we have, Tanzanian roots, we have Indian roots as well, and Pakistani as well. So, in that food bank, we've fed well over 1,000 people. It's not something we advertise. It's not something that we raise capital for or anything like that. But it is something that we do just to try to give back to the community what little we can. At the same time, I'm in the process of launching my own nonprofit financial literacy platform. It's called My Fin Journey. And basically the goal is to discuss the types of things that Chad and I are discussing today, just how anyone can go from making $0 a year to 100K, 200K, whatever your number is. But ultimately that number is not really the goal, right? If money is a tool, you don't seek to acquire a new calculator as the goal in life, or a new hammer, or a new, some people do car and house, and yacht, but it's fine. So really money is a tool to use to make the world a better place, in my opinion. So that's really what I'm going to be focusing more of my time on, is really building out content to help people scale, to help people, reevaluate how they approach situations. Because a lot of the times there's a lot of collaborative opportunities and we don't realize that. And that collaboration can bring the person you're working with hundreds of thousands of dollars and you. So it's one of those things that if you communicate your need, that's somebody else's superpower, like Chad mentioned, that's an opportunity for your need to be met, that other person to make money, and then everyone scales. And I think that's really what I'm going to be focusing on in 2024, aside from killing it in real estate.
That's incredible. And folks, I know you said you don't raise money for the food bank, but if that did touch your heart, if that's something that you'd like to support, you can navigate to the Quattro Giving Fund at thequattroway.com/philanthropy. And there's a donate button right there. Just put in the episode, or put in your notes for your donation the name of Mustafa and the Tanzanian Food Bank, and we will ensure that check makes it to where it needs to go. So we are set up for that. Happy to help facilitate that along the way. So Mustafa, thank you for coming on, sharing some of your time, your talents, your wisdom, your knowledge, and just, really putting on a good show for the investors, man.
No, I appreciate the time, Chad. Thank you for setting this up.
All right, folks, this has been another episode of the Real Estate Runway Podcast. If you got any value out of this show, like it, subscribe, pay it forward, make sure someone else sees it who needs to see it. All right. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out.
Bye.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway Podcast.